Residential properties with the same characteristics differ in market value because of one variable: location. The U.S. Bureau of Economic Analysis reported in April 2015 that the stated total dollar value of the 1.89 billion acres of land that comprises the United States was $23 trillion in 2009. The deep crash of the nation's financial and property markets brought about losses in the value of residential land in many, but far from all, regional markets. Despite millions of properties changing hands following borrower defaults under the terms of mortgage loans, land and residential property values gradually began to recover as the bottom of the recession passed. A key reason was the Federal Reserve's move to lower mortgage interest rates to rates not seen since the 1950s, thus enabling property buyers to obtain higher levels of financing. This expanded affordability is capitalized into higher land prices and carried forward into higher prices for residential properties. As we know, all property markets are local, often neighborhood by neighborhood, so that the demand for residential housing units with the same characteristics will vary greatly. What determines the demand and the market price is locational advantage, and locational advantage is a matter of many variables, some associated with geography, others associated with the quality of public goods and services, as well as other amenities that make a location highly, moderately, or minimally desirable. FNC Inc. produces this hedonic index of residential property prices based on the data collected from public records and blended with data from appraisals. The addition of the appraisal data provides the physical property characteristic data that is often missing from public records. The procedures used to create the index are viewed by some analysts as superior to the repeat sales housing price index used by FHFA and Standard & Poor Case-Shiller for measuring the recent boom-to-bust cycle. To reiterate an extremely important observation, consistent with what we all intuitively understand, a nationwide index has limited value because the land markets across the United States are so diverse. What can be said is that the cost of land plays a fundamental role in the ability of communities to expand the supply of decent, affordable housing. Two consequences of skyrocketing land prices are sprawling development and long automobile commutes. The Housing Affordability Index showed a decline in affordability during 2016 and 2017 as residential property prices continued to increase while household incomes remain stagnant and mortgage interest rates have been raised. Here are the most recent statistics. As these charts indicate, new residential construction has continued to increase annually since the end of the last recessionary cycle. What these charts do not indicate is where construction has been most robust around the country. For the year 2016, the highest number of units approved for construction was in Texas, with just under 166,000. State-by-state statistics on median sales prices of residential property provide some insight into the cost of living in each state, but again, in each state there are many markets differing in whether there is sufficient supply to meet demand or sufficient demand to meet supply. These 8 states, plus the District of Columbia, reported median sales prices for this period above $300,000. As one would expect, the strongest price increases occur in the nation's largest MSAs, metropolitan statistical areas, the exceptions being second home markets. The National Association of Realtors reported that for the first quarter of 2016, the median price for existing single-family properties increased in 83% of the nation's MSAs. The U.S. Census Bureau reported as of the third quarter of 2017 that the national homeownership rate is 63.9%. Despite record low mortgage interest rates during the recovery period from 2008 on, achieving homeownership has proven to be difficult for young adults. Households headed by adults under age 35 have a rate of homeownership of just 35.6%. Stagnant or declining household incomes, combined with the high cost of rental housing and shortage of affordable entry-level properties in many markets, are significant obstacles. The 2017 report on the state of the nation's housing by the Joint Center for Housing Studies of Harvard University states that the supply of properties offered for renter occupancy is diverse. In the nation's 100 largest MSAs, detached single-family properties make up 24% of the rental stock. Attached single-family units add another 7%. Thus, the overwhelming supply comes from multifamily structures comprised of 2 or more units. 1 out of 4 units is in a building comprised of 30 or more units. The center's forecast notes that the cost of rental housing is a significant drain on the household income of millions of individuals and families. The report stated, "A decade of unprecedented growth in the rental housing market may be coming to an end, according to our 2017 America's Rental Housing Report. Fewer new renter households are being formed, rental vacancy rates have risen, and rent increases have slowed. At the same time, renter demographics are changing, and nearly 21 million households continue to pay more than 30% of their income for rent." In reaction to the new tax bill passed by the U.S. Congress and signed by President Trump, Diane Yentel, President and CEO of the National Low-Income Housing Coalition, stated recently, "While the preservation of low-income housing tax credits and private activity bonds avoids an immediate devastating impact on affordable housing, this bill will exacerbate our country's already yawning income inequality and will harm efforts to end homelessness and housing poverty. At a time when we should be increasing investments in solutions to the housing crisis impacting low-income people across the country, the increased deficits created by these tax cuts puts the National Housing Trust Fund and other vital housing and community development programs at risk of deep spending cuts down the line." There is something local communities can do to stimulate the development of new units of affordable housing that requires no financial support from the state or federal governments. The solution is actually quite simple and supported by decades of economic literature. Exempt housing and all property improvements and move to a land-only property tax base. This can be done over a period of years so that owners of vacant and underutilized but valuable locations can decide to invest in new improvements or put the land on the market to sell to someone who will. This proposed change in the way local governments raise revenue was endorsed as long ago as 1980 in the report Compact Cities, Energy-Saving Strategies for the 80s, issued by the Subcommittee on the City of the Committee on Banking, Finance, and Urban Affairs. The report explains the link between speculation and property taxation. The spread of urban growth into suburbs and exurbia, consuming open space and farmland, is only one aspect of sprawl. The other side of the story is the large inventory of vacant in-city land. Private owners are not putting these sites to use because they find it more profitable not to do so. The profits from passively waiting for land value to rise appear higher and more certain than the yields from active production on the sites. Every parcel or tract of land has some potential annual rental value. This rental value attaches to locational advantage, as described earlier in this analysis. Thus, rental value is community created and not a function of what any individual owners of land do or do not do with the land owned. There is no more appropriate source of public revenue than this land rental value. As the report explains, the land tax tends to stimulate more appropriate investment on land as the tax increases. Since the tax does not change the productivity of the site or the quantity of land available, the owner usually cannot shift the land tax to tenants or customers. If the land tax is too low, owners have little pressure to make the best possible use of their sites. In summary, the state of the residential property markets in the United States very much depends on where one lives, whether one has a sufficient income to afford decent housing, whether one owns land in a highly desirable location, and whether one happens to reside in one of the small number of communities in the United States that have embraced the concept of moving to a land-only property tax base. Thank you.